What influences move the market?
So each market is very specific in terms of the factors that drive it. And so when you come to currency markets, it's all about interest rates. And so the question is why? Or at least over the short term, let's say 3 to 6 months. Currency is cash. And what do you do with cash? You stick it in a bank, and the bank will pay you interest rates. Well, nowadays maybe not so much, but it used to be the case. Back in the early 80s, you could earn maybe 14, 15% by sticking it into a bank. Now, let's say that
India, I hear, still does good rates.
So does Norway. Norway, I think, does maybe 1, 2%, something like that. Australia does 1.5% now, at least short term. New Zealand does. So there's still some countries that pay. I think Russia does even more. Certainly Argentina, Brazil do even more interest rates. I think Brazil is something like 8% or 9%.
Yeah.
But so this is then interesting. So the question is, if I live in a country where I get negative interest rates, but there is a country with massive amounts of interest rates, wouldn't I have the desire to invest over there? And so the answer is yes. And so obviously, interest rates are important because they represent the amount you can earn on your investment. Ultimately, this is what people want to do. That's why they invest in things, to earn returns. And the way you earn return on cash is interest rates. So interest rates drive currencies, and it's the most important factor. And who sets interest rates, at least over the short term? Central banks. And that's why people go absolutely nuts when central banks change their policy. And so it's to a certain extent ironic when central banks over the last decade or so try to engage in forward guidance, make it clear or become transparent to the market which way they're going. Problem is, their forward guidance wasn't necessarily that forward, because if you look at the reactions in the markets, they tended, at least on particular days when the central bank releases announcements or makes statements, you did have very wide price ranges on those particular days. So that shows you again how important these central bank setters are.
What are the key fundamentals for currency?
So we covered interest rates, because currencies are cash, cash earns interest, so you look where the interest rates are. Now, we also said that trade drives currency flow. So therefore you have a market exchange rate, as you see on the broker screen, 120 for pound. But imagine this, which is a favorite example because it's easy to understand. You're going on a holiday trip to the States, and you're in New York City, and you're thirsty, so you buy a bottle of Evian water. You don't open it up for whatever reason, you bring it back to London. Now you walk past a corner store in London, you see the exact same bottle. Same label, same plastic, same water, same everything. Now, let's say that you spent $1 in the States, and the bottle here is £1. Now you could swap these two products and you wouldn't notice it because they're identical. So $1 to £1. That makes the exchange rate 1. On the other hand, I just said the exchange rate in the market is 120. So because we have this flow of cash due to international flow of goods and people needing to exchange prices for goods, and because goods themselves have an inherent value separate from cash, they also impose an exchange rate. And this is called the purchasing power parity exchange rate, PPP for short. And so you can always compare that to where the actual market quotes it. If you want, it's the same as with equities. You know, a value investor will look at an equity and say, well, it's got this inventory and it's got this factory and it's got these assets, and so the value should be this. But the market is either quoting it way below or way above. So it's actually very conservative, or has overlooked it and it's a gem, or it's completely hysterical and I should completely ignore that particular company. So it's the same with currencies. Some currencies are massively overvalued for whatever reason. There's always lots of reasons why. And some currencies are very undervalued. Now, these kinds of factors actually take way longer to play out, maybe 3 to 5 years. So what you're therefore looking at when you want to trade this is not so much look at one currency and trade it maybe over the next 6 months based upon value, but look at rank currencies according to their intrinsic value and then keep on oscillating and buy the ones that are undervalued, sell the ones that are overvalued, and keep on oscillating and extract profit out of the markets by looking at these value trades. So we said therefore long term it's about prices and stickiness of prices and about inherent value of things. Over the medium term, it's interest rates, 3 to 6 months, because the central bank sets it. And over the very short term, it tends to be momentum, trend following. So when price moves in one direction, it really does move. And that's driven sort of by market hysteria by flows necessitated due to financial transactions, mergers, and acquisitions. So that's maybe over the 2-week, 3-week to 3-month horizon. Then you've got very short-term kind of movements, which in essence are mean reversion in nature, and that's the one thing that we exploited in our fund for the very fact that you don't. Certain assets tend to be very explosive. If you look at commodities, when they go, they do go, and stocks as well. You know, penny stocks can go to $10, $20 overnight. Currencies just don't do that. They trade in the band. And so by exploiting that kind of mean reversion, which means it just yo-yos up and down, you can always decide to trade at the edges and go against the move and try to capture that. So you've got these various factors that drive profit. And by focusing on these in various proportion to the amount of money you have, you can construct a portfolio that grabs the results.
So would it be fair to say that you have to have a good grasp of fundamentals in order to trade in currencies, or can you do it without really understanding fundamentals?
So the question is, how do you represent these fundamentals? So when people say they understand something, what is it that they actually understand? So let me be very, very specific. When I approach fundamentals, I try to find or be able to express them numerically. So some people will have economic arguments and look at the entire kind of dynamic as to one social factor will influence other people to take a decision, and then out of this comes an outcome. So that's sort of economic thinking and the kind of stuff you find in textbooks with these cobweb diagrams, which tend to be very hand-wavy. And the other approach is to try to quantify what you're looking at and then look at history to see what influenced it or what that level influenced the market. And so, do I have a deep economic understanding of the fundamentals? No. Do I understand where to get the numbers from and create maths models and have a deep understanding of the maths models? Yes. And so that's the approach I would take. So I suppose it's a long-winded answer. Depends upon your approach, not necessarily.